All right, let's talk about a big warning sign that just started flashing on Wall Street, Bank of America's bear signal. We're going to break down what it is and what it might mean for what happens next.
Look, it's the question on every investor's mind right now, especially after the incredible run we've seen. The market's been on fire, but is the party finally coming to an end? And the reason we're even asking this question today is that one of the market's giants, Bank of America, just saw a very closely watched indicator do something pretty important. It is officially flashing sell. Okay, let's dive right into this. What exactly is this signal, and why is it getting so much attention all of a sudden? The easiest way to wrap your head around this is to think of it like a fever gauge for the market. When investor excitement gets really, really high and things just get too hot, this indicator suggests that, well, a cool down might be right around the corner. So what is this gauge, really? Let's decode the BofA indicator and see how it actually works. So this is the official name, the BofA Bull and Bear Indicator. It's a pretty simple scale, just 0 to 10, and it's tracking investor sentiment and where the money is going. But the key phrase here, the one you really need to remember, is contrarian indicator. That means it's designed to go against the herd. When everyone is feeling extremely optimistic, this indicator says, whoa, wait a minute, maybe things are a bit too good, and it suggests a pullback is on the horizon. So where are we right now? Well, the latest reading just jumped to 8.5. And as you can see, that's firmly above the 8.0 threshold that Bank of America considers its official sell signal. We just crossed the line. So what tipped the scales? According to BofA, it was a mix of things that all point to some really high optimism. First, a huge amount of money poured into stock ETFs. Second, the rally's breadth got wider, meaning more stocks around the globe were participating. And finally, hedge funds got less nervous, and they started reducing their bets on market volatility. Okay, but a signal is only as good as its track record, right? So does this thing actually work? Let's find out. Now, this isn't the first time this alarm has sounded. In fact, since 2002, this signal has been triggered 16 times. So the crucial question is, what happened to the market after the signal flashed? And here's the data. On average, the S&P 500 fell 1.4% in the 3 months that followed the signal. Now, that's not a massive crash, but it is a clear negative return. Historically, it is pointed to a dip. But as we all know, averages can be pretty misleading. That negative 1.4% number, well, it's really just the tip of the iceberg, and it doesn't even begin to tell the whole story. Just look at this range. After the signal in October 2017, the market actually ripped higher, gaining almost 10% in the next 3 months. But after the signal in April 2002, it was a total bloodbath, with the market plunging over 23%. So the crucial point here is that this signal is a warning, not a prophecy. So we have the indicator and its history, but what does the human expert behind the report actually think? Let's get to the strategist's view. This is Michael Hartnett, Bank of America's chief investment strategist, and his take is that investors are betting on a run-it-hot scenario, where everything just keeps accelerating. But he's pumping the brakes, saying he personally doesn't expect company earnings to be strong enough to justify all that optimism. So why is he so cautious? He points to 3 headwinds. First, rising unemployment in the U.S. Second, the return of bond vigilantes. These are investors who push for higher interest rates, and they could slow down the massive spending we've seen in AI. And third, China isn't providing the big economic stimulus package that some had hoped for. So if he's so cautious, what's his advice? Well, he suggests positioning for a world where inflation might be cooling off. This means looking at assets like zero-coupon bonds, which are really sensitive to interest rates, and also considering the often overlooked mid-cap stocks, companies that are smaller than the giants, but bigger than small businesses. He also suggests exploring emerging markets and keeping a close eye on natural resources. It's a very different playbook from just riding that big tech wave. Okay, we've covered the signal, we've covered the historical data, and we've covered the strategist's personal take. Let's pull it all together for your final takeaway. First, let's just ground ourselves in what's actually happening. The S&P 500 has had a phenomenal run, surging 15% so far this year. The momentum is undeniably strong. And you have to weigh that strong performance against this historical warning sign. It's a contrarian indicator that, at least on average, has a track record of predicting that a slowdown is coming. Which leaves us with the ultimate question. On one hand, you have a market that is just roaring higher. On the other, you've got a flashing red light from a major bank.
So when a strong market meets a bearish signal, how do you find your signal in all of that noise?